All right, everyone. Welcome to our event for Spectra. My name is Jason Grillo, and it is a pleasure to see you all here today. We are gathered today to talk about the 2025 year in superpollutants and have an esteemed panel, which I'll introduce you to shortly. Happy to say that 2025 was a very interesting and impactful year for superpollutant activities. And that's what we're going to unpack here. For some logistics, this is going to be about a 35, 40-minute long panel discussion followed by a Q&A with you, the audience. This is being recorded, so please be mindful of that. And will be posted onto our SpectraClimate.com website afterwards. Noting too that there also might be a couple of members of the media, not just in the panel, but in the audience as well. So please keep that in mind. Why are we here? Superpollutants offer a very interesting opportunity going forward. That's why we're all active in the space. The idea is that they constitute about 45 to 50% of all temperature warming to date. And to that end, solutions to combat that and reduce the progress of climate change, reduce the progress of global warming, and ultimately have that impact rapidly by mitigating and destroying and abating emissions of gases that have many, many times the global warming potential of CO2 is a worthwhile pursuit. The quote unquote emergency brake public campaign that we saw earlier this year in 2025 is predicated on that story, on that imagery, on that metaphor, so to speak. This is, to be clear, we still need to abate and otherwise mitigate CO2 and remove CO2 emissions from the atmosphere. This is an all-and approach. It is not either or. There are some very interesting complementary aspects of CO2 activities, both to abate and to remove excess CO2 that have intersections with superpollutant activities, which we can talk about at a future date. Today, though, we're going to talk about the year that was in 2025. What were some drivers and barriers, and maybe have a look forward to what are some of the opportunities and challenges in 2026. To that end, happy to introduce our panel shortly. And if you have any questions, please put them into the chat so that we can collect them and have them for the Q&A at the tail end of our event today. And I'll have a couple of housekeeping items at the very end for the last 2 minutes or so, so that we can tie things up. So with that in mind, let's get to the panel. So we have Kirsten Love, Marketing Director at Tradewater, Hope Raymond, Carbon Markets Lead at Quantum Commodity Intelligence, and Reid Calhoun, who's the founder and CEO of ClimateWells. Why don't we just do some quick introductions? Kirsten, Hope, and Reid. We can go in that order and learn a little bit about you for the sake of our audience today.
Awesome. Thanks, Jason, and good afternoon, good morning to everyone. I'm Kirsten Love. I am the Chief Marketing Officer at Tradewater, where we are a mission-based B Corp focused on scaling superpollutant solutions as quickly as possible. Right now, we're focused on 2 key solutions, one of which is collecting, controlling, and destroying halocarbons or old refrigerants, mostly, and then also plugging orphan oil and gas wells here in the U.S. I've been with Trader about 6 years, and I oversee our market development, our sales, as well as our marketing and communications teams. Hope.
Awesome. Thanks, guys. Nice to meet everyone. My name is Hope Raymond. I manage the Americas Carbon team with Quantum Commodity Intelligence. We're a London-headquartered news and price reporting agency for environmental markets and other commodities. And I have my background in agriculture primarily, and then I have written and priced CDR markets and other carbon markets over the past several years.
Thanks, Jason. I'm Reid Calhoun. I'm the CEO of ClimateWells. We are a project developer in the voluntary carbon market, mostly focused on methane from old and aging oil and gas wells. Our projects shut down oil fields before they would otherwise be shut down. Additionally, we run Methane Plus, which is the largest open source database of methane and super pollutant activity in the voluntary carbon market, where we track buyers, sellers, purchase prices, retirements, issuances, and try to provide some transparency to the market around super pollutant activity.
All right, great. And to that end, about super pollutant activity over the last 12 months, we've seen, we've seen that there's been a heightened interest in the form of improved offtakes, improved volume of retirements over the last several years, with 2025 being a real bumper year. According to Allied Offsets, the super pollutant retirements and offtake volume increased 29% in 2025 relative to a previous high in 2024. To get things started here, from your point of view, Hope, I mean, again, you see a lot of things from that kind of 20,000 foot view. What were some of the factors that drove this? And Reid and Kirsten maybe can speak to some of the aspects, some of the factors that drove growth in your respective project areas. But Hope, why don't you start us off?
Yeah, absolutely. I mean, I think we've seen a broader kind of shift of mindset amongst buyers and other market participants. We definitely saw, the big crash in 22 and 23 and the emergence of CCP labels, which has definitely started to help the market, for good projects. And we also saw CDR taking off immensely over the past few years. And I think CDR is a great and effective tool, but it's much more long-term than something like methane or HFCs or other super pollutants measures to control those emissions. And so I think what we've seen really in 2025 is a lot of initiatives that were focused just on CDR expanding to include super pollutants, and also a lot of buyers kind of moving more and more investing in super pollutants today because they want to see those emissions now and not in 2050, 2040, whenever we have, scaled DAC hubs and et cetera. And so I think there's been a real shift in the market and how they're thinking about how they can make the biggest impact today and still invest in those longer term solutions that we see in the engineered space side of the market.
Great. Great. And just to probe a little bit, I mean, are you seeing growth in like landfill gas or HFCs or other, nitrous oxide, I should say? I mean, what are the,
Yeah.
yeah,
I think there's definitely been a lot of interest in those kind of smaller, less known gases, particularly with some new protocols being developed. Definitely HFCs, and even they're moving into the HFC destruction methodologies, which I think will be super key for this market. But yeah, I think overall, we've seen growth and improvement in prices over 2025. I was just looking at some of our prices for methane in Bangladesh, for example, nearly doubled on the year from around $2 to $4 over 2025. But we also saw a real interest in what Reid and what Kirsten are working on with the plugging of oil and gas wells. I think that has really kind of piqued the interest of a lot of people in 2025 and has kind of brought light to the development of that that segment of the market as well.
great, great. Picking up on that, Reid, maybe you could speak to some of the trends you've seen in the oil well capping field from your perspective, working on marginally producing oil and gas wells.
Sure. Yeah, the first methodologies for trying to figure out how to reduce methane emissions by shutting down an oil well were done in 2024. I think maybe ACR was 2023. I don't know the exact time. But principally, it's two buckets. It's like finding a well for which the operator or landowner or person who owned it is no longer there and measuring how much it's leaking, and then like taking the well over and shutting it down. Or going to one in which there is an owner and trying to compel them to shut it down while it's still active, profitable, 5, 10, 20 years early, both of which are, meaningful emission reductions in methane. They're very tangible, very measurable, often local to where companies are headquartered, and they're immediate and fairly reasonably priced and permanent. So there are a lot of reasons why I think these projects began to take off in 23 and 24 and 25. So in 2024, of all methane projects, shutting down oil wells only made up about 1% of issuances. But in 2025, you're looking at somewhere between 4 and 5% of issuances. My guess is that shutting down oil and gas wells will be 25 to 30% of overall methane credit issuances by 2030. The elephant, in the methane space at least, is landfill gas. Typically around 10 million tons of issuances per year. That dropped in 2024 down to 8 million tons, but back up to 11 million tons in 2025. And then, fairly consistent issuance size from wastewater treatment, leak detection and repair, organic waste, and coal bed methane. Those haven't really grown year over year in the last about 5 years. But we saw in plugging oil and gas wells an 8x multiple on issuances in 1 year. Could just be because it's early. But I also just think there's a lot of old oil fields, and measuring the emissions from those oil fields is really straightforward. There are methodologies on American Carbon Registry and methodologies in the works there. There are methodologies on an open carbon protocol. Climate Action Reserve is building a methodology. Gold Standard is building a methodology. So as far as growth of new methane project types, we see that as a pretty big one. Now, an interesting take is, United States in 2025 made up 47% of methane-based credit issuance, whereas only about 17% of retirements. The vast majority of retirements from a project location point of view is Asia. So right now we've got a spike in new issuances in the US, but a lot of those retirements in Asia are from old projects. So my guess is you start to see a shift into US-based project retirements. But if you take out renewable energy credits, the market actually had a banner year of retirements. So we're seeing significant growth in methane and super pollutants across the board.
Yeah. Reid, if I may just ask a quick follow-up. Hope alluded to how Bangladeshi methane prices are increasing from $2 to $4. Are you seeing any price differences between, say, Asia versus US-based well capping prices for credits?
Wells, plugging wells for carbon credits has been, let's say, on the low end, like of credits that get a rating of, call it triple B or better. I can't speak for the ones that don't face that. I think one of the big reasons why these projects are doing well today is because most of the good ones, like, they rate well. So of projects that get that triple B or better from one of the large ratings agencies, I think you're looking at around 18 to $22 per credit. So significantly above what you would see from leak detection and repair in Asia. But average methane credit retirement price in 2023 was $4.28. Average in 2024 was $4.36, and the average in 2025 was $7.56. And that's across all methane credits. So significant lift in methane prices and retirements between those years. But yeah, landfill gas credits can perform at $4, and there's a lot of landfills. So I think you have to want to do projects that have other benefits in order to jump at that like $15 to $18 range. Shutting down oil wells is interesting because a lot of these are urban. A lot of them are next door to where people live. You get major agricultural benefits. So, they fit within a portfolio quite well.
Great. Thank you. Kirsten, we'll be curious to get your take on not just the, slightly different segment of the oil and gas well capping, because you handle often and abandoned primarily at Tradewater rather than marginally producing oil and gas wells, but also about what you've seen in the refrigerant destruction markets too.
For sure. I think maybe starting on the methane piece, just to build off of Reid and Hope, as Reid mentioned, there's no shortage of orphaned or marginally producing wells. There's a lot of them in the way that we've built our oil and and gas infrastructure here in the US. So there's a big opportunity, low-hanging fruit, if you will, to go after these wells and address these methane leaks, as well as other leaks that are coming from these wells. As Reid mentioned, there's leaking other toxins, and they're in proximity to farmland, to where people live, where schools and urban areas are at. So being able to address those really, I think, provides a great solution, low-hanging fruit solution. It is a bit more expensive than landfill gas, but again, you have these other benefits. And I think that is something that the market has to really adjust to. It is a bit more costly to do these projects, but there is a lot more benefit on the backside of it. And I do think enabling these projects has really been through the production of new protocols and methodologies to allow project developers to go out into the market and create these credits and then sell them. One interesting thing I think overall from a super pollutant perspective is that the spend on these credits has increased, but it's still relatively small to other projects that are being developed. These projects, even at that $25 to say high level mark, $25 or less, have a significantly more bang for the buck, but still are about 1% of the overall spend in the voluntary carbon market. If we can just divert a bit of that spending where we have credits that are a bit more expensive, we can diversify that portfolio, just divert 10 to 20%, we can have a massive impact on our ability to slow warming. And also falling into that super pollutant bucket to talk about the other side of our work is the collection, control, and destruction of old refrigerants. So we're actually focused on CFCs and HCFCs, which precurse HFCs. A lot of acronyms, a lot of letters. But those are the gases that were addressed under the Montreal Protocol, that there's still billions of tons, 21 billion tons of emissions still out there in the form of CFCs and HCFCs. So we don't want to forget about, again, collecting and destroying those, what I would call low-hanging fruit. There's a tried and true process to do this. It's measurable, it's permanent, as Reid and Hope already hit on. And I think that's really attractive to the market as you start to balance out that portfolio and you include things like direct air capture, nature-based, and you also have these solutions that really provides a nice sound portfolio where you're hitting both the near-term and the long-term impacts of climate change.
Great. Can you maybe speak a little bit to the dynamic of abatement versus destruction? I mean, how's that played out in your work?
Yeah, so on the refrigerant side, we're destroying those gases. That is the only way to prevent them from permanently leaking into the atmosphere. Once these gases, all these non-CO2 gases, they cannot be sequestered from the atmosphere. So we have to either permanently abate them or destroy them. And the option of refrigerant gases, there's an option to destroy. In methane plugging, we're permanently preventing those leaks and abating those emissions.
Great. Follow up to the panel about what you might be seeing in nitrous oxide activity, noting that should have said this at the top. There's certainly a distinction between the short-lived climate pollutants of methane, tropospheric ozone, CFCs, HCFCs, versus long-lived superpollutants such as nitrous oxide, such as SF6, such as other perfluorocarbons. So thinking about nitrous oxide, which has 300 times the GWP of CO2 is measured on a 100-year basis, also stays in the atmosphere for several hundred years. What are you seeing in that particular segment of the superpollutant space? Again, feel free anyone to speak to that.
I won't necessarily speak to market dynamics, but just from what I've seen in the market in terms of like protocol development, we've seen Climate Action Reserve like really focusing in on these areas and trying to launch new protocols in China and India and other regions. So I think that will definitely help push the market forward as those kind of become more in the public eye.
Yeah, just to piggyback on that, I would agree. I think there's a lack of workable methodologies right now, but they're in the works. As soon as those become available, I could see project developers developing projects because of the super potentness of those gases and the ability to find them and in certain industries and destroy them. There's definitely, I think, appetite there, but we just need the methodologies. And I think that's kind of reflective of the evolution of the market, right? We saw the methodologies develop in the methane space, so we saw more activity. So as those develop, and then you have rating agencies taking a look at them and providing their perspective as well, it allows for that activity to grow.
Great. Thank you. So thinking about some of the participants in the market so far, players who have purchased super pollutants to the degree that you can speak to them in aggregate or anonymously. What are some of the major sectors that have supported super pollutant solutions? And is there a distinction between the sectors that say support the methane, nitrous oxide, and other versus F gases, or are they all kind of participating in each of those, mitigating each of those gases at about equal pace?
From my perspective, it seems as though the companies that are attacking at least methane have to have a very specific reason why they're going after methane. Um, Historically, you've looked at food and ag and large dairy companies. They have a specific reason because they've got methane in their supply chain that unfortunately they can't cut. We've seen secondary education start to move towards methane, colleges and universities, because they see that as like probably the quickest way, just from an intellectual point of view, to take on these projects. Uh, and then, in 2025, Salesforce, Google, Cascade, Terraset, others that kind of came out with the verbiage that methane's and superpollutants made up 50% of all warming to date. It's got to be more than 50% of your portfolio, or more than zero of your portfolio, as you think about offsetting emissions. So I'm hopeful that the companies that have historically worked on just carbon see that there is an opportunity to expand into this portfolio with something that is verifiable and permanent and clear. But writ large, the carbon market has been led over the last few years by large tech companies, Microsoft making such a huge piece of that. And so those companies maybe don't have as much super pollutants in their in their like supply chain as others. But we're hoping that they take the lead going forward on these super pollutants.
Thanks. Kirsten, Hope, any thoughts?
Yeah, no, I think Reid said it well. Definitely seen universities pop up and secondary education. I think because they appreciate the rigor and the science behind the work that we're doing. Tech companies as well have started to lead the charge and started to incorporate them into their portfolios. We've seen new phrasing and new thoughts on this, like stacking, in terms of being able to match both your short-term impact and your long-term impact, and stacking those credits together. So it's been slow moving, but I think we're headed in the right direction. And as more people understand the impact that these credits can have, also the impact relative to the cost, I think as that becomes more well known and educated in the market, then we'll start to see that grow across. But we've had customers across all sectors, but I would say two of the bigger ones, as we mentioned, have been tech is always being a leader in this space, and then universities and colleges.
Yeah, no, absolutely. I mean, we attended the Yale Cooling Conference this past year as well, and saw a really great turnout of buyers. Google was there. We saw some others, and so definitely seeing that uptick in interest, especially on the kind of academic side, but also from the buyers, like Reid said, with Terraset expanding from CDR into super pollutants as well, purchasing from Tradewater, for example. And then we also had Google buy from Recool and Cool Effect as well. And so definitely seeing that uptick. And I think getting some offtakes by Microsoft wouldn't hurt.
So if you're out there, Microsoft, and listening, here's your chance.
I think the registry activity has also been pretty interesting to watch. In 2022, Vera made up 65% of all methane project issuances, and in 2025, they were down to 19%. Whereas ACR in 2022 was only 8%. Now they're at 28% of methane issuances. Climate Action Reserve was 5%. Now they're at 20% of methane issuances. So I think we're starting to see a little bit more balance in registries as it takes to methane and super pollutants.
Yeah, and on that note, we've also seen kind of an expansion from smaller registries as well in the space. We have B Carbon doing oil and gas plugging. We've got Carbon Path and Open Carbon Protocol. I know Tradewater and Reid have worked on protocols with them as well. So definitely, I think good seeing developers working with those protocols to really make sure that it aligns with the science and how the projects can be developed.
We've also seen, as I said, an uptick in the rating agencies taking a look at these projects. Historically, they've looked at where the most activity has happened, which can be a challenge because these are newer projects, but we've seen some of those rating agencies take a look at these and really establish that the science is real here. They're measurable, they're permanent, and they are high impact. And I think that's been really helpful. Hopefully, more rating agencies will take a look at these super pollutant projects and not just focus on the current volumes, but the volumes that will be coming in the future years and where buyers are starting to have interest.
Yeah. So just to note, I put this for a later topic, but since it cropped up now, I'm just curious to get from you all, to what degree do ratings agencies have influence over the movement of super pollutant credits? Is this a market where ratings agencies are necessary? Are they nice to have? Where do what are the roles that ratings agencies can have at this point that we saw in 2025 and maybe into 2026 too?
I think it depends on the buyer. A lot of buyers really do lean into rating agencies to help with their due diligence process. Others may lean into intermediaries along with rating agencies, but I have seen an uptick in a request for that rating, which again makes it challenging when some of the rating agencies aren't looking at these types of projects. So really being able to completely tell that story, I don't think it completely removes the need for due diligence and the need to kind of have that conversation with buyers and help them to understand the projects, but it's definitely playing a bigger role.
Yeah.
I can only speak to B0, Calyx, and Silvera. When we compare their ratings, most of these super pollutant or methane projects will rank between either a double B on the low end up to an A on the high end. MSCI tends to give a lot higher ratings for these, but generally they rate well. If you compare a super pollutant project at the averages versus carbon removal or nature-based solutions or household devices or cook stoves or improved forest management or any of these others, across the board, super pollutants are as high or higher integrity projects. So I think when we were investing heavily in red and there was this flight away from those into carbon removal, the narrative was these are higher quality. But when you look at 1,000 projects under 3 different ratings agencies, kind of find that that isn't the case. And that in reality, super pollutants are, from a ratings only perspective, the highest quality and the highest integrity projects in the market. And
just to be clear, there are super pollutant projects that are many of them are very highly rated, but Reid and I, you and I were talking earlier, some of them are not so highly rated. Just as in carbon removal, there are some highly rated projects and some projects that aren't as well. So
just to note on that, I know Calyx just put out a recent article with Yale as well, saying that only about 40% of their super pollutant credits fall within the A, AAA, or AA. And so there's still obviously room for improvement there, and the other 60% to get that past to the B level.
Yeah, lots of work to do. Thinking back to 2025, what was a story that was kind of below the radar that hasn't cropped up so much? What's a success story and that we want to talk about that hasn't really made the headlines so far?
Yeah, I can start just coming off of a fresh trip to COP30 in Brazil this past November. So we definitely saw a lot of momentum for super pollutants at COP. A lot of it kind of I got undershined, I think, by the negotiations and other kind of initiatives that were announced, but they had the third methane and non-CO2 GHGs summit with China, Brazil, and the UK, and they announced the Super Pollutant Country Action Accelerator. And so they're going to try and mobilize $150 million in their first tranche, and aims to support, I think, about 30 countries by 2030 to reduce their super pollutant emissions. We also saw the super pollutant hub grow significantly. Those panels were packed every time that I attended one. So that was definitely great to see. And then we also saw 9 countries agree to tackle black carbon emission sources as well. And so kind of just a broad expansion, I would say, and kind of the focus on methane and some of these other very high GWP gases.
Yeah, and I think I also saw an SF6 report come out from a source as well. Yeah. Reid, Kirsten, any underreported stories or things that you've seen that are worthy of mention?
I'm excited to see what X Prize comes out with on the methane
Mm.
prize. Um,
Mm.
it's been really fun that a lot of the leaders this year on methane were very specific to carbon dioxide removal in 2023, 2024. And if you consider the leaders in the carbon market as those that were really highly focused on durable carbon removal, seeing them shift to wanting to put a lot of capital into super pollutants is a great boon for confidence in the space.
Yeah, definitely. I think the notion of a diversified portfolio and being able to have some of these open conversations with those that were previously only CO2, kind of behind the scenes has been really great. And hopefully some of that will come out more into the forefront in 2026. So people get excited to talk about their commitments and their leadership in the super pollutant space. I believe that will then cause for some of the medium-sized actors and the smaller actors to take action as well. And again, hopefully that will come a bit more to light in 2026. But this idea that it's a yes and we have to do all of these things, and these are the more immediate solutions, the low-hanging fruit. The science has continued to back it, but it's really nice to see the science take the stage and be recognized in various aspects. I think New York Climate Week was also very super pollutant heavy, and a lot of conversations, people looking to learn and understand what are the solutions out there and how we can have impact. So hoping that those things will continue to come to light in 2026.
Yeah, something else to note as well was within nationally determined contributions, there was a recent report that said like the mention of methane and other super pollutants grew 20% from the last submission in 2020 to the current submission that we've been seeing roll in over the past few months, a little late. But yeah, overall, definitely seeing that as well within NDCs. So will definitely become more prevalent within the Article 6 markets as well.
Mm. What activities have you seen in, thanks for all your insights, all of you. What insights have you seen in terms of, or in terms of stacking credits? Again, we've seen, some protocols say you can do this and you can add another credit on top of it. Have that become more commonplace? What trends have you seen there over the last 12 months?
I can jump in from more like if as companies are looking at their portfolio, this notion of stacking has come up, or another way to say it is diversify your portfolio, make sure you're addressing short-term plus long-term solutions. And that has been coming up more and more often. Again, those that were highly focused on carbon removals and really in making those initial investments to get those going are realizing we also need to do something for the short term. And I think, again, realizing it's a yes and how do we diversify that portfolio? As I mentioned, right now about less than 1% of spend is on super pollutants in the grand scheme of the voluntary carbon market. And so being able to just diversify even just 10 to 20% can have a huge impact. And whether you call it stacking or diversifying your portfolio, I think it's what the science says and it's what we need to do. So excited to see it come up in more conversations.
Great.
We see some projects that will try to get carbon credits and also NOx and SOx credits or other air pollution credits. I'm always wary of that, given what we saw in CCS credits, where you took advantage of the 45Q and then also try to sell some carbon credits to make up that gap. You have to do some attribution on, how much of an emission reduction was caused by each crediting type. And I think you get into questions around additionality when you're getting paid in other ways to do a project. Diversification for sure. I think there's so many companies who made a certain type of commitment. We're going to do nature-based. We're going to do carbon removal. I don't think it's worth our time to try and say, don't do that, do this. Instead, I do like to see that they just expand their focus a bit. And I think in general, that's been good Still, 65% of all methane credits that were retired in 2025 were done by energy companies. Outside of tech, I mean, energy tends to continue to lead the retirement space. I think that's tough though, because no matter what a large energy company, whether that's a utility, oil and gas, or otherwise, that they're still producing fossil fuels, and I don't think that whether they invest in nature-based solutions or methane emission reductions, they're going to get a whole lot of credit for that, because kind of their main source of business is one that works against that space.
And
Understood.
I would definitely agree with Reid. I think that the additionality bit definitely becomes a concern. And then once you have to kind of really get into the nitty-gritty of which emissions are being reduced where, it can, I think, very easily blur the image just for, even for the buyer and make it even more of a challenge.
Yeah. Speaking of challenges, maybe we can speak to some of the barriers we saw crop up in 2025. It's a time when U.S. federal support waned for not just for super pollutant activity, but for climate in general. Or is that or just to challenge that a little bit, is that even a correct assumption? What are the barriers that we saw particularly in the United States that came up for super pollutant activity in the last 12 months?
I think the White House, not just super pollutants, obviously, but just in general. I think the demand got pushed down the road a bit. That's all. For some.
Okay, thanks, Dan.
Yeah, I mean, I think overall, just like the back and forth from the federal level and between the states, like it again blurs the image for buyers and people investing in this space, which obviously prevents, additional capital from flowing and projects progressing, projects scaling, etc. But yeah, I mean, I think on a very nitty-gritty level, I think the funding from pulling out of the Paris Agreement, stop funding the UNFCCC, pulling out of all these international organizations, really puts a large funding gap there to reach some of those goals, like the methane pledge, particularly within the super pollutant space. So I think in the long term, unless we rejoin and recommit to some of these things, I think it'll be a larger challenge moving forward to get these done without the kind of purse of the US.
In light of that, sorry, Kirsten, please.
I was just going to add really quickly that it definitely left a gap and hole, but I think what was most reassuring was that leaders continue to lead in the voluntary space, right? Those that were maybe on the fence of entering the market may have stayed on that fence or said, let's sit out for a little bit more to see what's happening, but the leaders continue to lead. And hopefully that momentum will continue into 2026 and beyond, and help those that were on the fence to kind of get back in the game and to accelerate some of that funding in light of our government not doing those things. So yeah, just wanted to add that really quickly.
Great. Actually, that's a perfect lead into what I was gonna ask next, is to ask what sector, what area needs that most consolidated corporate support, knowing that at Spectra, again, we're a super pollutant education and credit transaction alliance. So educating sectors of the economy it's what our intent is. So I'm curious to ask you all, what are you seeing in terms of particular areas where we can consolidate some of those activities?
I have seen at conferences that the core questions asked by sustainability leaders is, how do I build consensus at the CFO or financial level to rally more funding towards climate action? When it comes to methane specifically, the science out this year is really compelling. It's that the damage prevented by by stopping methane today. If you put a cash value on the climate damage you prevent by stopping methane, you're looking at about 2x the value of stopping a proportionate amount of CO2. So 1 ton of methane or 25 tons of CO2, you're stopping about double the damage to that 1 ton of methane. And additionally, that 1 ton of methane mitigation is probably about half the price of doing some sort of equivalent permanent CO2 reduction. So really, it's like a 4x cash on cash return on investment in comparison to carbon. Maybe that's a compelling pitch to the financial C-suite. I still think it's a storytelling exercise. So, we have to do a better job at talking about the storytelling of shedding methane, or in our case, an old oil field, whatever it happens to be. I think people think of these industrial gases as being just an emission reduction without having a face or a community or health benefits or ecology or other stories to tell. But that's getting better. I think great leadership by Salesforce and Google and otherwise will help change that in the next year.
Yeah, I think, Reid, you bring up an excellent point. I think one of the bigger barriers that we saw this year is the understanding of price in this market and what it costs to do these methane projects or to do non-CO2 projects in general. It's a variety of projects that all have different costs associated with it. But we found that price point and what you're doing with Methane Plus to really illuminate that $20 to $25 range is the cost to do this work. But if you do compare that to other projects outside of non-CO2, you really get the bang for your buck. So like you said, it is a 4x return for every dollar invested. And then when you couple that with CO2, now you're looking at a 7x impact on the environment. And so being able to really tell that story and help folks to understand that it may not be as cheap as a landfill gas credit, which is also very much needed and should have a place in the portfolio. These projects, this is the cost to do them, but they also have other benefits, as you mentioned, the social impact, the impacts they're able to have to air, soil, and water health with plugging these orphaned or marginalized wells.
Yeah, no, I would just echo the sentiment there on the well plugging and the abandoned versus marginal. I think just growing the understanding of what that problem really is, where the responsibility lies based on, titles and land changes and companies going bankrupt, etc., would really help buyers truly understand that credit type a bit more, and also those health benefits surrounding it. Often I've heard from developers, they're near schools, they're near homes, like near hospitals, and that's a very clear story, I think, to tell. But also just trying to give the base understanding of what is this kind of newer credit type that's seeming to get a little bit more recognition now, and seeing how it develops.
Great. Thank you. Last question, then we'll get to Q&A. Can you pick out any examples of either good storytelling or good situations where operations and sustainability professionals came together to create a compelling project or compelling story behind a super pollutant project?
We shut down an oil field behind a youth baseball field in downtown LA, sponsored and retired by JP Morgan. JP Morgan's been focused on methane for a decade or longer. So they put out independent methane reports to try and really track that gas. And, their focus there was the job creation. It doesn't take a whole lot of jobs to emit methane, but it does take creation of jobs to come and shut it down. And so I think whether it's job creation or location, or you want to talk about health, there are stories to be told on these super pollutant projects, but that's just one example.
Yeah, I think following along the methane, we've done some projects that are on farmland. And so you think about the impact to air, soil, and water where we're growing our food is pretty compelling. And I think having leaders in the space that are not afraid to lead and say, super pollutants are important, we should include it in our portfolio, is extremely helpful in that. So Workday did an initial offtake with us to make sure that those wells were plugged, and also help to amplify that story through partnerships with Beyond Carbon. There was a nice documentary done in which we were able to interview one of our landowners, and he was able to talk about the impact. And we're able to go out into the field and you can see new soybeans growing where there was once this huge obstruction where you had to farm around it. And that's pretty cool. It impacts the local people. It impacts, the food that we're eating. It impacts the local economies, as Reid mentioned. And those are cool stories to tell. And I think we'll get hopefully more platforms to tell these stories. So thank you, Jason, today for that opportunity. And I think as more corporates step up and talk about the work that they're doing and the pledges and commitments they're making, it allows for that platform to grow as well. And we can really realize the whole benefit of doing these projects.
Excellent. Excellent. Thank you. So we are just about at Q&A time. So if anyone has any questions or for the panel, feel free to, if not put it in the chat, then raise your hand and we'll get to some additional questions from you, our highly valued audience. Everything. So I actually have. Whoops. So sorry.
I don't know how to. Oh, hold on.
Oh, sorry. Go ahead, Dan, please.
Am I muted or can you hear me?
No, I can hear you perfectly.
Okay,
Thank
cool.
you.
I don't know how to raise my hand. I just looked to see, and I don't see it. So anyway,
All good.
so Reid, I got a question on the because it would help us promote it more on the methodologies. Are they abating the next 20 years of leaks, or are they verified every year and then issued?
For the existing orphan well methodologies again, an orphan well is one for which there's like no solvent owner. It's just like out there in a field leaking. I think those issued 20 or more years of credits up front. For the ones we work on where we shut down an oil field early, the upcoming methodologies under Climate Action Reserve and Gold Standard will issue annually based on, real measurements in the field.
Cool. So I mean, I love the idea of both. And I always get a little bit of pushback from folks when I discuss ex-ante credits. These aren't really talked about as ex-ante credits, but they seem to be ex-ante credits to me. So how do you get people over that hump?
So for the projects that we work on, it's like, the well would have emitted X amount of tons in 2025. The credits are issued at the end of 25. That's an ex post credit.
Right.
I'm not the specialist on the orphan well methodologies that issue X post credits before the emission reduction would have happened. That's probably there's a lot of ratings and reviews on that topic. So if you want to take a look at B0 or Calyx or Silvera, they have rated a bunch of orphan well projects and can sort of write about that. I know that upfront crediting works in some cases where, for instance, like Tradewater captures a bunch of well, I'm going to say this wrong, but refrigerants, right? And has these credits, destroys the gas, it is gone forever. So, credit issuance in bulk at that time, not only is the activity permanent and completed, but also the gas is gone. It's never coming back. There's no counterfactual in the future about it. So
they move into abatement in most cases, right?
Yeah, that makes sense. I think certain cases in which you issue credits up front for an emission reduction that would happen in the future, there's different schools of thought on how to do that. But either way, the activity happens one time. You're not having to go do new sampling next year. The well's gone. It's plugged and been removed out of the ground. Yeah. So look at it either way. I think the ratings agencies do a good job at kind of distinguishing between those two. I think it comes down to how much conviction and how much reliability do we have on the counterfactual in those cases.
Yeah, and just to add a little bit more clarity on the orphan oil and gas wells, there's various methodologies out there. Some are 20 years, some are a little bit more. An open carbon protocol, which is the one we're doing our credits on, is currently at 20, but there is a holdback for the first year as you go back out and confirm that the well is plugged and there are no additional leaks. So there's some nuance to that, and I think we will continue to evolve these methodologies as we learn more and the science get better. The more wells we plug, the more data we collect to understand how they behave and what the impact is. But yeah, happy to dive into more detail offline if that's helpful. But I do think looking to the rating agencies is a great way to look at it. Also looking and doing your own due diligence on the methodologies and protocols is great. One great thing about the or the OCP is that all the comments are public, so you can see what those questions were, what the responses were in terms of those very detailed questions. I think that's a great layer of transparency offered through that registry in particular.
Yeah.
Awesome.
Thanks, Cheryl, for that.
All right. Thank you, Dan. John McDougall has a question as well.
Yeah, I can paraphrase the question. I mean, we talked about buyers being on the fence. I heard that. Taking a step back, not just for methane, which and other types of super pollutants, which is certainly very important, and I'm on board with all that. But what we're seeing right now is a stagnation of market or a flight to quality, and or potentially in many cases concerns around the utility of offsets. And whether or not they can be used as a mitigation measure or rather as a contribution. And so, I always, being in this market for the last kind of 15 years, the use case of this has always been fundamental to purchases of credits. And so with that under fire, I'm curious if you guys are your kind of some lessons learned or engagement with groups on whether or not offsets can even be used to offset or mitigate emissions versus maybe just being a philanthropic type purchase.
Hi, John. We don't really convince people to buy offsets who aren't buying offsets. Doesn't really happen that much for us. Be really cool if that did happen, but for the most part, unless they really, really wanted to shut down oil fields and have been outside of the offset market, of which we've had some great conversations and buyers there. For the most part, the groups that we work with have had the conversation internally about how they think about offsets. As for like how I would battle that claim, I'm mostly going to lean on like the claims guidance out there. I think that the VCMI and ICVCM have made their take. You see ACROA sort of, I guess what it seems like leading to them as the new leader on how offsets can be used. Frankly, and I said this at the beginning, like, yeah, we do see stagnation, but I'm looking at that as a now lack of new issuances and retirements in renewable energy credits. The fact that we've had such a anti-environmental administration in now for a couple of years and overall retirements, if we take those recs out, is up, to me feels like as big of a win as we can get if we have a new administration in here in a few years. I think the market has shown that it's somewhat resilient there. But every company's got to have their internal combo about how they're going to handle this. The thing that scares me is we get to 2030 and there's a lot of commitments that come to bear, and whether those companies decide to kick that commitment down the road or buy a bunch of offsets. I think that actually comes down to LP response. I think if investors have seen these sustainability commitments and seen companies pull a tractor supply where they step away from all their sustainability push, and the LPs don't respond, they continue to invest in those companies, they don't pull their capital, I think everybody will start to ditch their sustainability goals. I also think that SBTI could do a better job here, but I'm super biased that I want them to recognize offsets across the board. But I'm sure that there are smarter minds at ANU and otherwise who have thoughts here.
Just to highlight real quick, it'd be interesting to hear other slides, but just that you hit the crux of it on the 2030 targets, on whether or not people are going to back out of their targets or if they're going to look around and see what their competitors are doing and seeing this as a real utility. So I certainly align there.
Great. So want to also thank you for that, for the questions and for the response. Tyler Marcus is, by the way, just to introduce him to you, Tyler's advising SPECTRA on the formation of our organization. So Tyler, you had a comment that you wanted to mention?
Yeah, thanks, John. I think it's the right question, and Reid, your response makes sense. I think, we don't pretend to know the answer, but I think that one of the things that we are aiming to do, especially in the super pollutant area, and especially for in SPECTRA, is to make sure that it is seen as much as an operational solution as it is a carbon credit option. And that's why we will strive and are aiming to combine operations folks with sustainability leads. We want credits to be perceived in some ways as a financing mechanism for solutions. And so that's our worldview, and that's something we'll take forward. And hopefully that begins to address, John, what you're talking about in that stressing the use case.
And
Great.
just one other really quick comment. I think the additionality story is really clear here on the super pollutant projects. And if not for the carbon market, a lot of these projects would not happen. And so I think that becomes a really strong story with buyers and those that are kind of on the fence of, you know, if you want to have meaningful climate action, you want to have the big impact, and you want to invest in something that wouldn't otherwise happen if not for your purchase of the carbon offset credit. I think that's very clear here. Also, we're seeing other folks come to the table and have conversations around it. You mentioned SBTI, Reid. Hopefully we'll see some new guidance from them, which will expand a bit more their perspective on offsets. We've also got TCAT, ICBCM, VCMI, all of these acronyms that are really emphasizing the importance of the carbon market. And if we want to get in scale in terms of climate action, it won't happen without the market. So.
Okay, great. If there are no more comments from the panel or from our audience, I just want to say we are just about at the top of the hour. So I wanted to wrap things up. Thank you so much to our panel. Thank you to the audience for participating today. We really appreciate it. We will send out a thank you email afterwards once we have the recording set up so that you'll be able to view it. I put the panelists, if you have questions for the panel, put the panelists' emails into the chat. Also, please, we will at Spectra would love to hear from you. So Tyler and I are hard at work on our open consultation about what the organization can be, how we want to structure it, what can provide the most value to the super pollutant activities in the community going forward. That includes buyers, especially, and corporates who want to support super pollutant projects, as well as for what suppliers of credits or project developers of super pollutant projects want to see. So that's open until January 31st, spectraclimate.com/consultation. But I put the link in the chat as well. Feel free to just let us know what you think and how we can work together in the future. So with that, I just want to say thank you once again, all. Thank you, Tyler, for your, as always, excellent advice. Thank you to the panel for coming. And we will hope to see you all at another Spectra event soon. Thank you.
Thank you.